The main difference between ETFs and index funds lies in their buying and selling processes. Despite both having low expense ratios, extra fees associated with these investments can vary significantly, with most brokers not charging costs on ETF trades, whereas the charges for selling index funds can be substantial. As a result, ETFs are more suitable for maintaining minimum costs. Additionally, many index funds require minimum investments, which can be thousands of dollars, whereas ETFs have no minimal purchasing requirements, making them more convenient for individuals with limited funds. In terms of tax effects, ETFs are generally more tax efficient than mutual funds. When selling shares of an index fund, investors are subject to capital gain taxes on any gains. In contrast, when managers make changes to ETF portfolios, investors are not subject to taxes. Index funds, on the other hand, need to make portfolio adjustments by buying and selling assets to follow the underlying index, which can result in capital gain taxes that deduct from the value of the index fund shares. The management of funds also differs between ETFs and index funds. Most ETFs are passive investments based on the performance of a specific index, although they can be actively or passively managed by fund managers. In contrast, the majority of index funds are actively managed by fund managers. Overall, ETFs are more convenient in terms of management. Despite their differences, both index and exchange-traded funds are ideal long-term investments for most investors, offering a wide range of diversified stock market exposure. Both have their strengths, depending on one's investment needs. However, ETFs have certain advantages, including no minimum investment requirements and more favorable tax treatment. Ultimately, the choice between ETFs and index funds depends on individual investment goals and needs.